The death of the IPO, why companies are staying private and what IT means for investors. 1. The vanishing IPO. In 1996, there were 739 initial public offerings in the United States. Last year, there were about 225. The number of publicly traded companies has been cut in half, from more than 8,000 3 decades ago to around 4,000 today. Companies aren't rushing to the stock market anymore, some are even heading the other way, going private. So what does that actually mean? It means fewer investment opportunities for everyday people and more concentration of wealth in private hands. Footnote. The number of public companies has declined sharply, reducing retail investor access to early-stage growth opportunities. 2. The purpose of going public. At its core, an IPO, initial public offering, is how a private company raises large-scale capital. It's like a business version of passing the hat around to the general public. By selling shares, a company exchanges a little control for a lot of cash. That money funds expansion, R&D, and acquisitions. Public companies gain transparency, prestige, and access to new markets. But they also gain a new master, the market itself. Every 90 days, they must answer to Wall Street's stopwatch. Footnote. Going public provides capital and credibility but subjects companies to ongoing disclosure, regulation, and market volatility. 3. The private money boom. In the 1980s, going public was almost the only way to raise hundreds of millions. Today, private money flows like never before. Venture capital, private equity, hedge funds, and sovereign wealth funds together form an ocean of off-market capital. These players, Saudi Arabia's Public Investment Fund, Singapore's Temasek, Norway's Oil Fund, can bankroll billion-dollar ideas without a single share ever hitting the exchange. So, companies can grow massive while staying private, skipping Wall Street entirely. Footnote. Vast private capital sources now allow companies to delay or avoid IPOs entirely. 4. The weight of regulation. After the corporate scandals of the early 2000s, think Enron and WorldCom, Congress tightened the screws. CEOs must personally certify earnings, and companies face constant audits, disclosures, and compliance costs. Going public now means millions in annual regulatory expenses and relentless scrutiny. For many founders, it's like trading freedom for paperwork. So what does that actually mean? It means they can raise billions privately and skip the bureaucracy entirely. Footnote. Regulatory compliance has become a major deterrent to public listings, especially for smaller or fast-growing firms. 5. The tyranny of the quarter. Public markets demand constant performance. Miss your earnings target by 1 cent, and billions can vanish from your market cap overnight. Netflix once lost 20% of its value in a single day for missing subscriber estimates. That kind of pressure breeds short-term thinking. CEOs delay innovation to hit quarterly targets. Going private, meanwhile, means freedom from Wall Street's microscope. It's patience over panic. Footnote. Quarterly reporting pressures public companies into short-term decision-making, discouraging long-term investment. 6. The power of the few. The fourth reason for the IPO decline is consolidation. Tech giants like Google, Apple, and Meta have made an art of buying up rivals before they mature. Many startups now dream not of IPO glory but of a lucrative buyout. Private equity firms add to this, swallowing mid-sized businesses and keeping them private for profit. The result? Fewer independent players, more monopolistic power. Less innovation, more control at the top. Footnote. Frequent mergers and acquisitions concentrate corporate power and suppress market competition. 7. The economic fallout. When fewer companies go public, fewer ordinary investors share in the wealth of innovation. Growth stays trapped behind the velvet rope of private markets. Wealth concentrates among venture funds, hedge funds, and insiders. And without public oversight, risks multiply. Remember FTX? Private empires can implode unseen. The fewer public listings there are, the greater the danger of unchecked corporate behavior. Footnote: declining IPO activity limits public wealth creation and increases systemic opacity in major private firms. 8. The case of Figma and Adobe. A perfect example, Adobe tried to acquire Figma for $20 billion. Regulators blocked the deal. Figma later went public, at a higher valuation than Adobe's offer. The outcome? More innovation, more competition, and consumers who actually win. When big fish can't eat the small ones, the ecosystem thrives. It's capitalism as it was meant to be, not a monopoly buffet. Footnote: regulatory intervention in mergers preserves competition and consumer choice, encouraging market innovation. 9. The bigger picture. IPOs aren't extinct, but they've evolved. Today, companies go public when they're already giants. Think Uber, Airbnb, or perhaps one day, SpaceX. Investors get fewer early-stage opportunities, and founders get more independence. It's a double-edged sword. Innovation thrives in privacy, but public access shrinks. The market of tomorrow is less democratic but more efficient, depending on who you ask. Footnote: modern IPO trends reflect a trade-off between market transparency and private growth autonomy. 10. The future of public markets. Will IPOs ever make a full comeback? Maybe. Economic cycles, regulatory reforms, or investor pressure could revive the old model. But for now, the new rule is clear: only the giants ring the bell. The rest prefer silence, and private money never sleeps. Footnote: the decline of IPOs represents a lasting structural shift in how capital formation and wealth distribution occur.